Most traders think their problem is finding the perfect strategy, but the truth is, even the best setup falls apart if you don't understand what type of entry you're taking. In this video, we're breaking down the 4 core entry types every trader must master, so you can stop guessing and start executing with precision. You'll learn the 4 foundational entry types and how they differ, how each one fits into market structure, the strengths and weaknesses of each approach, common mistakes traders make when using them, and how to pick the entry style that actually fits your personality and strategy. By the end, you'll have a clear framework for identifying, labeling, and mastering your entries, instead of winging it trade by trade. Why entry types matter. Most traders treat entries like a coin flip. They see something that looks good, hit buy or sell, and hope it plays out. But behind every trade is a structure, and every entry you'll ever take falls into one of 4 core categories: breakouts, pullbacks, reversals, or liquidity grabs. Understanding these gives you clarity and consistency. You stop reacting impulsively and start executing with intent. Instead of blindly entering because a candle broke out or a pattern formed, you'll know exactly what type of trade you're taking, why it makes sense, and what conditions support it. This clarity is what separates random traders from strategic operators. We're laying the foundation, a framework you can build on in future deep dives for each entry type. Breakout entries. A breakout entry happens when price pushes through a key structure level, like a previous swing high, range boundary, or trend line, and you enter as that level is broken. Breakouts work because momentum traders and institutions pile in together, causing powerful expansions. Strong displacement candles, volume spikes, or clean structure breaks often signal valid breakouts. The upside: quick moves, less waiting, and potential to catch strong trends early. The risk: fakeouts. Not every break is real. Some are liquidity runs in disguise. Smart breakout traders wait for clean structure breaks or retests to confirm intent, rather than blindly chasing the first wick through resistance. Pullback entries. A pullback entry waits for price to return to a key level after a strong move, whether it's structure, an order block, a demand/supply zone, or a fair value gap. Institutions rarely chase price. They let it pull back to fill orders, and you can do the same. This entry type typically follows a BOS, or displacement move, then patiently waits for price to return. It's a favorite of structure-based traders because it offers tight invalidation and strong RR. The downside is patience. Sometimes price never comes back and you miss the trade. But when it does, pullback entries often offer some of the cleanest, most reliable setups in any strategy. If this is cutting through the confusion, press like. It helps more serious traders find this channel. Subscribe if you want steady, no-drama training. Reversal entries. A reversal entry looks to catch the turning point of a price move, entering against the current trend at key exhaustion zones. This often happens after a liquidity sweep, when price takes out equal highs or equal lows, then shifts structure in the opposite direction. Reversal traders watch for clear signs that momentum is changing. This can include a break of structure, often abbreviated as BOS, or a change of character, pronounced chotch, like it rhymes with watch. They also look for strong rejection candles, or clean displacement that signals a shift in control. The upside of reversal entries is obvious. If you time it well, you can catch major tops or bottoms early, with huge risk-to-reward potential. But the risk is higher. If you misread the turn, you're entering straight into momentum, and that can get punished fast. Reversal entries demand strong confluence, solid market structure awareness, and the discipline to avoid forcing counter-trend setups just because you want to catch the top or bottom. Liquidity grab entries. A liquidity grab entry happens when price deliberately runs stop-loss orders above or below a key level, then sharply rejects and reverses direction. Institutions use these stop hunts to fuel their real positions, taking liquidity from trapped traders before moving the market where they intend. As traders, we wait for the grab to actually occur. For example, when price wicks above a previous high or below a previous low, and then look for confirmation in the opposite direction. This confirmation can come from a break of structure or clear displacement, which shows a decisive shift in momentum. This approach gives you surgical entries at premium or discount levels, often with minimal drawdown, because you're entering right as the market flips control. Liquidity grabs are one of the highest precision entry types, but they demand patience and timing. You're waiting for the trap to spring, not trying to predict it ahead of time. Choosing the right entry type. Not every trader thrives with every entry style. Breakout entries suit momentum traders who like fast, decisive moves and want to ride expansions as they happen. Pullback entries fit patient, structure-based traders who prefer high risk-to-reward setups and don't mind waiting for price to return to key levels. Reversal entries are best for contrarian traders who understand exhaustion zones and have the discipline to wait for structure shifts before taking the opposite side of the move. Liquidity grab entries attract precision hunters, those who focus on key levels and have the patience to wait for stop runs before striking. The goal isn't to trade all four types at once. It's to understand them deeply so you can specialize in one or two that fit your natural trading style, while still recognizing the others when they appear. That awareness turns confusion into clarity. You'll instantly know what type of trade is forming, whether it's one you personally take or not, and how it fits into the broader market narrative. Integrating entry types with market structure. Entry types mean nothing without context. The most powerful trades happen when the type of entry aligns with market structure. For example, breakout entries work best during expansion phases, right after a break of structure, pronounced BOS. Pullback entries often occur as price returns into order blocks or zones at premium or discount levels, giving you clean continuation setups. Reversal entries are most effective at liquidity sweeps near higher timeframe zones, where price has reached exhaustion and structure begins to shift. And liquidity grab entries shine just before a structure change, when price run stops above or below key levels, then flips direction with clear displacement. By linking your entry types to market phases, accumulation, manipulation, expansion, and distribution, you stop taking random plays and start stacking confluence. You won't be forcing trades where they don't belong. Instead, you'll time them to fit naturally into the market's flow. This is where strategy evolves from theory into systematic execution. Common mistakes with entry types. One of the biggest mistakes traders make is mixing entry styles mid-trade. For example, they'll enter on a breakout, but then manage it like a pullback, or expect reversal-style risk to reward from a momentum entry. Each entry type has its own behavior, its own invalidation logic, and its own expectations. When you blur those lines, your trade plan loses consistency. Another common trap is treating every small price movement like a valid signal, especially on lower time frames, without confirming alignment with the higher time frame structure. This leads to overtrading and chasing noise. Many traders also fall into the habit of trying to trade every entry type at once, spreading their focus too thin instead of mastering one or two. The fix is simple but powerful. Clearly define your preferred entry types, know exactly what confirms them, and stick to your playbook. If this video helped you see the market differently, hit like and subscribe for the next chapter.